consumer products and retail investors. We back everything from apparel and accessories brands to food and beverage, beauty, and disruptive retailers. All of our investments to date have been in brands, not necessarily tech. Our firm started way back in 2015. We've raised 4 funds since our inception. And a lot of our early investments have gone on to, become multi-$100 million companies at this point. So we have a lot of experience kind of in the consumer products domain. Like Alex said, we are dedicated equity investors. We don't do any debt. So that's a little bit about us. I live in New York City. I've been in New York since 2009. Grew up in New Jersey, and that's the story.
Cool. Thanks for introducing yourself. So let's dive in. So today we're going to be covering 5 metrics that your investors and lenders really care about, starting really from revenue growth to moving to unit economics, covering liquidity, asset efficiency, so how really quickly you move through the assets that you have, and also to finish up, we'll be covering leverage as well. So on the revenue growth side, this one I think is the simplest one, easiest to explain. So when you're just really looking at how much you're growing year over year, you'll just be looking at today's revenue versus the prior period's revenue. So when you kind of think about where you want to be or what numbers you should be seeing, growth rates of above 50% is really a strong revenue growth rate. 25 to 50 is fairly healthy, especially I think in this environment where there's a lot more pressure on getting profitable, not burning too much money. I think the environment relative to where it was the last couple of years ago is definitely different than today, and that really shows up in the public markets as well. And I don't want to speak for you, Bill, but I'm sure how companies operate in the public is a great way to kind of understand, how that kind of tracks for a valuation perspective into the private markets. Negative growth rate, obviously self-explanatory, not something you want to be showing, but there might be reasons why you might be doing that if you're cutting expenses or other reasons to trying to survive. So this is important both from a lender perspective and also I think investor perspective, when you want to see that, hey, this business can grow and it can scale. And then it just kind of makes underwriting due diligence a little bit easier as well. So a few ways to improve it. When you're kind of at a baseline, you can kind of think about potentially adding additional SKUs to kind of, sell more stuff either to new customers or to returning customers, looking at different channels. So a lot of brands will start out D2C initially, to really build the brand, but then to really gain distribution, it's all about getting into B2B and wholesale. Another way of looking at it is let's say you have a good motion on your marketing expenses, then potentially doubling down on that if you have something that's really working for you and just increasing your top line. Bill, what do you kind of see from this perspective?
Yeah, I would say our perspective, and again, we're equity investors, and I would say the benchmarks we tend to look at as early stage, again, seed to Series A stage, consumer products investors. I would say our benchmark is really, something closer to doubling revenue year on year, if not more than that. An important thing is important perspective on this is generally we and most other consumer focused VCs in the ecosystem generally are momentum capital, right? They're looking to fuel growth for businesses that have already demonstrated really clear top line growth in the business. And generally when we get involved with a company, a sort of middle of the strike zone investment for us is a seed stage consumer products company. We're looking for sort of, doubling year on year. I would say an important caveat is the quality of that growth matters a lot. I would say the quality of growth almost matters more now than it has in the past. And by that, I mean, we really like seeing, obvious metrics of retention, high rates of retention in a business. Does a company have a high repeat customer percentage, a repeat purchase rate? Is there a proof point in subscription take up that we're able to point to? I understand some of this might be challenging for some brands to really show in the early innings, especially if your entire business is selling through large format retail. You might not have the best metrics around retention. But if you do, and you're proud of those metrics, show those off. I think differentiating the quality of growth is pretty important in the early stages.
What kind of metrics, if they are selling, through retailers, would you kind of highlight? Is it like
I would
velocity?
say, yeah, velocity metrics matter, but again, that's very kind of category dependent. Like, bottled or canned seltzer is going to have very different velocity metrics than a snack brand or hummus or something like that. And so SKU level data and sort of SKU velocities are maybe a little bit more idiosyncratic and less comparable. Again, we sort of benchmark some of these metrics versus other consumer products brands that are raising capital. So yeah, some of those retail metrics would matter. I would say a lot of times the nature of some of the conversations we're having with early stage brands is when they come to us and they're raising capital, a lot of that is to fund growth. Maybe they have a purchase order from a Target or a Whole Foods. So they're raising capital in the context of fueling growth. And I would say those types of those types of anecdotes about a business, like if you know that you have a purchase order from Whole Foods or Target or something, that's very marketable, and that's something that an early stage investor like us is going to love to see. Are you going from 250K in revenue to $1 million in revenue overnight because one of these larger retailers has come calling? That's a really sort of surefire way to get capital.
Yeah, makes sense. So we'll definitely take questions about these afterwards. So save them down. The second metric I really wanted to highlight here is contribution margin. So the way to define that is really looking at revenue less any variable costs associated with that revenue divided by the revenue. You can definitely track this on a monthly basis. So I think a more typical, easier to understand metric would be the gross margins of your product, which is just revenue less the COGS divided by the revenue. But in actuality, what a better metric to really look at is to include all the related costs that are associated with selling that product. So if that's fulfillment, shipping, marketing, anything that's really variable around it. So fixed costs like the employees or software you might have shouldn't really be included in this, because when we kind of think about it is if you were to sell twice the number of goods but maintain the same fixed costs, where can your business go? So from our perspective, once you kind of calculate this and you're really showing 20% or higher contribution margins, that's a really strong position to be in. 10 to 20 is healthy, 0 to 10 is pretty okay. But if you're negative, at least for lenders, our perspective is like, that's just not going to work, because like if we're giving you more capital to really buy more inventory or buy more advertising, that money is just going to really deplete where you were before. So this is a great way to think about this. But with the caveat that early on you might not have economies of scale, so some things might be a little bit more expensive than they would be. But I would definitely recommend trying to understand like where you could get those individual components to be at in a really destination view. Just so let's say we double or triple in size, we could definitely get a little bit more efficiency in these individual components. So ways to improve this, definitely one way around it is really like, how can you reduce your COGS basis, if that's with your current supplier or potentially a different supplier. Product pricing is a great one. You might just be able to price your product higher. And I think that's definitely what a lot of companies have been doing in this inflationary environment. You might just be selling it at a price point that's just too low. Marketing efficiency. So really understanding like, okay, what marketing campaigns are working, what aren't. Let's cut the ones that aren't working and really double down on the ones that are very efficient. cost of packaging, fulfillment one, and also as you kind of think about different channels, that will have different contribution margins with it. So diving deep into those, you can really understand, hey, if we shift 30% of revenue to this channel, this is where our contribution margin might look like. Bill, would you agree? Do you kind of
Yeah,
view
I would say
differently?
the last bullet you could include there in terms of how to improve would be thinking about your business in terms of your product mix. So product mix we've seen to be a really significant driver of contribution margins and gross margins for a business. Meaning, if you sell two products, one of those products generates a significantly higher product margin and contribution than the other. Simply by focusing more, pivoting your business towards that first SKU is going to help you optimize your overall corporate margins. I would say, as from a diligence perspective, when we're evaluating companies, product margin and gross margin are really important measures for us. First of all, product margin just tells you a lot about how a customer values your product relative to how much it costs you to produce it. High gross margins, we've seen this with a lot of our portfolio companies, can help cushion EBITDA profitability from, periods of time where a company might need to make outsized marketing investments to drive top line, or make kind of crucial hires, bring on some more, corporate payroll. It's really an important cushion to fund a business that's generally in the first few years after our investment not going to be profitable, on the bottom line. So I would say, I'll just add another caveat, I guess, because I'm just going to caveat everything I say now. Gross margins are important, but they lack a lot of context. So and they could also be kind of very category dependent. You could have a beauty brand that does 80-90% product margins, and you could have a food, or household products company that's doing 35-40% gross margins. And I wouldn't say objectively one is bad and one is good. If you look at some examples in the public market, Nike does a low 40s% gross margin. Lululemon does, a high 50s% gross margin. I couldn't tell you objectively that Lululemon is a better company than Nike. I think it has way more to do with its distribution model, the category that it operates in, footwear versus apparel. And there's also some, context you need to understand around, like, some companies don't put fulfillment costs in their cost of goods. It might be buried in SG&A. So sometimes gross margins are not necessarily applicable, apples to apples comparable between companies. So generally, contribution margin is the better way to look at it, because contribution margin is basically going to strip out all of those variable measures to get a product to a customer. So for traditional food and beverage brand that sells mostly through retail, we look at what is your profit after trade spend, after your cost of goods sold, your broker fees, your warehouse costs, distribution costs. And then, if you're more direct to consumer heavy, we also tend to layer in what are your direct marketing costs. So we'll sort of take it one step further there, but contribution margin is a really important metric. And if you think about it, it's like kind of setting your business, the foundation for your business off which to scale from.
Yeah. One of our customers likes to say, he has this phrase, which I really like. It's like shipping pallets over shipping individual units, where it's just like, especially for food and bev, it just doesn't make too much sense, like shipping heavy products and low amounts directly to customers.
Yeah.
So that's why it's like, you just got to get into retail and wholesale, just so you get some product efficiencies there. Cool. Next one is liquidity. So this one's definitely important from a lender's perspective. So there's kind of two ways we look at it here. So one is cash runway, really looking at, your current cash divided by your monthly burn, to tell us, like, okay, how many months does this company have at the current pace, unless they make some changes, if that's in bringing in equity or some changes in profitability, and also quick ratio. This is a very important one that I think is really under considered. So this is really looking at your current assets, in this case, cash and accounts receivable, and dividing by your current liabilities. So to have, a greater than one quick ratio. So this means your cash and AR is larger than your current liabilities, and current liabilities is here really defined as, things that are due in the short term. That's going to put you in a very strong position. That 0.75 to 1.25 is fairly moderate, and below 0.75 is viewed as low. So it's going to be challenging to really get debt into the business, with at least cheap debt or flexible debt into the business. I think there's options with different MCAs out there that might not be looking at this kind of stuff, but at least from the lenders where you'll get something more substantial or something more flexible, then having a really good quick ratio is really important. And this really provides the lenders with confidence that the business is going to be around in the future, and that you can turn some of these current assets to cover the current liabilities. So ways to improve it, really controlling your expenses and burn, making sure you're not just spending stuff on stuff that doesn't really matter to the business. Utilizing debt appropriately. So debt is really, in this case, really focused on funding working capital gaps, and equity is really focused on, let's extend the runway, let's invest in growth initiatives. I think building some momentum fuel. So I think that's a good way to look at it. Anything you'd like to maybe add here from your perspective?
Yeah, I would say, generally, if you're talking to us for the first time, you're probably actively raising your first round of institutional capital. Again, that's generally where we're investing for the first time in a company. We're not going to be all that surprised as equity investors, especially if your company's been bootstrapped to date, that you're probably not going to have anything more than a modest cash runway as a business. And so I would say this is maybe a little bit less pertinent to us as sort of early stage equity investors. Where it becomes more important is as we invest in a company and we're sort of providing advice and strategy around subsequent rounds of fundraising, they go into a Series A, a Series B, really understanding sort of the cash runway of a business, how many months of capital it has, and sort of adjusting, really having some knowledge around what the calendar is going to have to look like for a company to be able to fundraise in an environment where it's not necessarily cash strapped. We've seen scenarios. I mean, there's, obviously always bad actors in the investing world who are looking for hobbled companies that might not have another choice and will need to take more of a predatory term sheet in equity capital raise at dilutive terms. So what we're really trying to make sure is when our companies are going into, we're trying to be proactive with our companies and making sure they understand where, when they need to start raising, and sort of thinking ahead. I would say the other thing to consider here is like, there's, obviously cash liquidity. Be thoughtful, as a founder and executive of a business, be thoughtful about the assets you have. And I know we're going to go into this later with asset efficiency, but you might have more ability to tap liquidity than you think based on your balance sheet. So, understand what's available to you based on the inventory that you're holding and the accounts receivable that you're holding. A lot of our companies will, leverage working capital lines of credit to be able to sort of leverage some of those assets on the balance sheet to increase their cash runway. And I would say the last thing is generally the companies that we are investors in the early stages and we're starting to invest in, I would say they generally don't have much debt on the balance sheet. Tends to be a situation we avoid at our stage. But yeah.
Well, one thing maybe you could add color on is, I think 2 years ago, rounds were getting done super quick, super fast, probably low due diligence. But I think, today is a different market. So from signing term sheet to getting wires funded, generally, what have you kind of seen as the time it takes just so these companies can, make sure and prepare accordingly?
I would say it's less like the time from a term sheet to funding, and it's more, what's lengthened is really the time from getting to know a founder and putting a term sheet in front of them, that's lengthened. So it's sort of like further upstream from that process. And then I would also say, like, generally what we've seen in a more difficult financing environment, is that companies will have rolling rounds of capital. And we've seen this, with quite a few of our companies, if they have an outstanding safe note that they'll raise against, or a convertible note. In moments where you might be talking to a bunch of different investors, being able to close on some capital against that, use that as sort of a marketing mechanism to talk to other potential fund investors. We've seen a lot of like rolling closes with some of our earlier stage portfolio companies. That's, allows you to sort of bring in that capital. You have an outstanding security that you're raising against. But I wouldn't say we've seen too much of a drift in terms of, like, once a company signs a term sheet and they close, that's generally a pretty defined period of time.
Yeah, and as from a settle perspective, we've definitely raised a lot of equity throughout our day. So
Yeah.
one thing that I'd kind of recommend is really building these relationships early with investors, and then providing, investor updates effectively to them to kind of show you the traction and the growth. Because I don't think anyone wants to get into shotgun wedding, especially for these like 10-year relationships. So that's something that's definitely worked in our favor historically. Cool. This one is my favorite one, covering asset efficiencies. So really, before we kind of get into the actual metric, we really need to dive deep into the three components of it, which is days of inventory outstanding, aka DIO, days sales outstanding, DSO, and days payable outstanding, DPO. So days inventory outstanding, I think it's pretty self-explanatory, but like how long is inventory sitting on your balance sheet? Days sales outstanding, so as you're selling into retail, what are your terms there from, getting AR and turning that into cash? If you're selling online, your DSO should be 0 since you're getting paid at the time of checkout. And days payable outstanding is how long are your payables sitting on your balance sheet. So how this kind of comes together is what's called a cash conversion cycle. So the number of days it takes really a company to convert cash it spends on inventory back into cash from selling its products. So the way to calculate this is you take your DIO, add the DSO, and subtract the DPO. So in this one example, this company has 5 months of inventory on their balance sheet, so 150 days. DSO is 30 days. Let's say they have net 30 terms from their buyers, and DPO, they're sitting on their payables for an average of 90 days. So adding those up, then we'll get to 90 days cash conversion cycle. So generally anything 120 days or longer is fairly viewed as long. It's going to be tough to really maneuver the business. 60 to 120 is really this average period. 0 to 60 is fast. And there's actually ways of getting it to be negative, which is really exceptional. There's definitely been a few write-ups on Gymshark in the Twitter ether that I would recommend taking a look at. The why this is important is because when you have 0-day cash conversion cycle or negative cash conversion cycle, you could effectively grow without investing any cash into it, and just having the revenues kind of offset that and help you just scale instead of just always requiring more capital. I know this doesn't pertain to people here, but as a lender, we definitely don't have a negative cash conversion cycle. We're always giving out money up front and then waiting to get paid back later. So it's very challenging for us to grow just because it's a very capital intensive business. And the more capital light business you could be, then the more attractive you're going to be across the board, just because it means there needs to be less money invested in the business to reach your goals. Bill, anything to add here?
Yeah, it's an important metric. Like you said, there's a lot of case studies out there. Gymshark was probably one of the more infamous companies that operated at a negative working capital, with negative working capital. I think Stitch Fix was another popular one. I think, it's important. I would say if you're operating in the world of like just traditional kind of consumer products, good, CPG, food and beverage, it's pretty hard to have a negative working capital cycle. I think it's like incredibly rare to see that in the world of like, sort of fast moving consumer goods categories. But there's some learnings. Like I think there's thinking about the business from how do I improve my terms, is just a good start. Like if I'm paying my vendors 45 days, why don't, is there scope here to push this to 60? And I actually, often as an investor, I would rather have a company with a, more attractive cash conversion cycle and tying less money up in working capital. I would almost prioritize that over profitability, because capital is such a finite resource. And so being able to invest more money into the business to grow it rather than tying it up in inventory, or receivables is just, it is a pretty big benefit. The last thing I would say is, we think about when we invest in a company, right? We think about how far is that dollar going to stretch this business. Is if we invest $1 million into a company seed round today, and a company raises $2 million against that, a seed round, how much growth is that going to fuel? And one of the ways to think about your cash conversion cycle is the more efficient you are there, the more you could stretch that $2 million seed round to drive more top line growth for the business, and hopefully ultimately more profitability for the business.
Yeah, no, that makes sense. We have one customer who has 120-day terms with their supplier. So it just allows them to be so efficient. So, they're, it takes probably 30 days for them to get the goods over the seas. And now they have 90 days to kind of really sell through this before they have to pay a dime on it, which is kind of amazing. But definitely, I think a lot of companies come to Settle really for this reason. Because, if we're adding, giving them 90 or 150-day terms, we're really helping them get their cash conversion cycle down to 0 or negative in many cases, and helping them scale. And the last metric we'll talk about here is leverage. So the way to define this is really the debt to equity ratio. So you're looking at your total liabilities and dividing by the total equity in the business. This is definitely a balance sheet metric. So why is this important? If you take on too much debt, too many liabilities, you might not be able to repay it in the future, which could really sink your business. So you definitely don't want to be over levered here. On the flip side, if you have too much equity, then that's obviously a good thing, but you might have given up a lot of ownership in the business as well. So debt to equity ratios of greater than 2 are viewed as very high risk across the industry. So that's an area you definitely don't want to be. The low 1s or less than 1. I think we might have a typo here for the ratio. Is a better place to be overall. And just something to be mindful for. Definitely, I think, when you're raising debt, is probably gonna be a better position. But as you take that debt on, and let's say you're unprofitable over time, that debt to equity ratio might shrink over time. So just something to be mindful of when kind of thinking about other opportunities the business might take on. Bill, do you guys kind of look at this? Not at all, or how do you think about it?
We do. I mean, we do. I would say generally we don't do a ton of transactions in the early stages when a company has a lot of debt on the balance sheet. It's just pretty atypical. It's hard enough to be an early stage consumer products investor. It adds an additional layer of complexity when the company has a lot of debt that sits above you as an equity investor in the capital stack. And so we're not really looking for a lot of opportunities where a company has a high degree of leverage, especially in the early days when EBITDA is generally negative. I would say one thing to consider here, and maybe this could be helpful, and this is probably people have already thought about, but the debt and use the debt and equity market interchangeably, and sort of think about the timing of raising debt and equity often in tandem. So a lot of times what we'll see is a company will raise a Series A round. And by raising equity capital, there are venture debt providers or other type of lenders out there who will provide generally more favorable terms to a borrower in the context of knowing that there's going to be maybe a few million more bucks of equity capital coming onto the balance sheet. So, a lot of times we'll see sort of, maybe 20% of the total value of a Series A equity capital raised also being raised via debt. So that's kind of a way sort of that we've seen some of our companies raise more capital in a way that's slightly less dilutive to them. But again, we're generally not investing in a lot of situations where there's a lot of leverage with the company. So it's just something to avoid.
Yeah, makes sense. And I think one thing overarching on these metrics is you really need to have clean data to really understand your business. And what that really means in this case is really having clean accounting books. If it's your P&Ls, your cash flow statements, your balance sheets. So definitely when we see a lot of early stage companies, like they just don't really have a good sense of their business. And in many cases, they might be using cash accounting when accrual accounting is really the proper thing to do to really understand the efficiencies in the business. So just as a plug, we definitely know a great number of accounting firms, fractional CFOs that are definitely willing to help out and really drive a lot of insights from your business. So, please reach out if you need any help there. So the takeaways that I take back are really, I think these metrics are really applicable to businesses at all stages. Obviously, there's a lot of caveats, different channels or different product SKUs will drive different metrics. What's really important, if it's equity or debt, really choose partners that really align with your goals. So something that might work for one company might not work for yours. And then also, utilize your team and network. Startup CPG, I think, is a great network for all these founders to understand, how your business might compare to other businesses, and how, what has worked for you that might work for somebody else, and help each other out. And just as another plug, we love for you guys to use Settle. So we're offering all the webinar attendees 2 months free of the Settle Plus plan. I think this is like $500 worth of savings. This could, I think, really help you get in a good place with your business, from anywhere starting with purchasing, managing your accounts payable, aka the DPO, and also working capital. So we'll definitely love to help a lot of the brands out here. So use promo code Startup CPG 23. I really need my radio voice right now. And just go to settle.com and get started. So yeah, with that, here's our info. Please connect with us, and let's move into Q&A.
All right, we've got some good questions. Thank you for that super valuable information. A lot of folks are asking for this presentation afterwards. I mean, it's just chock full of such great stuff. So I'm going to kick it off here with the first question. What's a healthy repeat customer rate that investors look for?
That's a good question. So there's a couple of definitions of there, within that, there's a few, kind of sub definitions of what repeat customer rate is. There's, what percentage of your customers that buy your product are repeat buying the product or coming back again and buying your product. There's also another definition, which is like your repeat purchase rate, which is how often are they coming back and buying the product. I would say, again, this is incredibly category dependent. For a fast moving consumer goods company like food or beverage, or household products or things like that, we would expect, a repeat purchase rate like every month, right? Or more, maybe more. I would say for maybe a beauty cosmetics company, it would just be a little bit less. And so it's kind of hard to characterize it just generally. From an actual repeat customer percentage perspective, if you can show data, and I know this might be hard for a lot of the companies on this call based on how they distribute their product, but if you're mostly direct to consumer and you have data that shows that 30, 40, 50% of your customers are repeat buying your product, that's great. And we love to see anecdotes like that.
Yeah, I would agree. Definitely a lot of the companies we work with, when we kind of see like a 30%, reorder rate, I think that's great. And, but I think it could differ, as you mentioned, different categories. We had this one customer who was selling shampoo, and depending on the size of the bottle, which means, higher AOV, lower AOV, that would have different reorder rates, clearly, because, you can only use so much shampoo. So they try to find the optimal, size of like AOV versus reorder rates, to really propel their business forward.
Thank you. Next one's a little long, it has a couple questions in it. So comes from Jamie. So our revenue growth rate is on the lower percentile, slower because we don't have marketing spend. D2C growth has been a major challenge. We're actively looking for a distributor and have gained slow momentum with retail. How can we validate projections for investors? Do we take historical data and combine with industry benchmarks?
I'll start. I think we generally don't really pay too much mind to like industry growth benchmarks. I mean, we're like I talked about earlier, we're generally looking for brands who can put up 50%, 100% plus top line growth. That's generally our benchmark. And so if a category, a growth consumer category in the US might be growing 5, 6, 7%, right? So we're generally not using industry benchmarks as sort of a template to think about growth for a company. We might think about what's like an addressable market. If a company operates in a certain packaged goods space and we know that category is $1 to $2 billion in retail, sort of understanding like what could be a trajectory the company can take with a certain amount of capital to achieve some market share of that category. That's another way to sort of anchor maybe some growth estimates of the business. I would say, also being able to say like we have retailers, we know we're going to be able to take share at retailers, or we're having conversations with XYZ retailer and they're going to commit to some type of maybe it's exclusive product with them, or maybe it's just some type of retail launch. Being able to like use that to help us underwrite our forward growth assumptions, that would be really helpful. The more kind of specific around those drivers you can get, the better.
Yeah, and I think
I don't know if that answers your question. I think maybe it was just a little bit kind of generic of a response, but it's kind of hard to know without really knowing the full context of the type of business that you operate in. And
yeah, and I think it's also important to understand like the incentives for both parties, right? Because like equity investors is really power law distribution. You're really trying to find the diamonds in the rough that are going to return a lot. And you're willing to, maybe, I don't know, have 30 or 50% of the investments go to zero or whatever it may be. But for lenders, it's the quite opposite. Like we don't get any upside, right? The only thing we're making is interest. So if a business grows, 200x over some time frame, like that doesn't really impact us. We just want the loans to be repaid. So like we're definitely willing as lenders to take lower growth rates, while venture investors are definitely going to be requiring really the best of the best.
Thank you. Okay, next question. It comes from Christina. Hi guys, who is funding pre-seed CPG food? Is it primarily angels/syndicates? Our first order out of the gate was a 6-figure order from a national retailer, and we are feeling the pinch, but don't have much historical sales data to borrow or raise against.
Yeah, I would say angels, syndicates, sort of like people in your network. The thing to remember is like the earlier the stage of your business, the more you're raising on founder market fit and the less you're raising on product market fit. So your network is really important. People who understand that you have outsized knowledge or experience in a certain category, really mining your own personal networks for, sort of that early stage pre-seed financing. I would say it's a lot. It's really more generally in the consumer packaged goods space. We see more kind of like high net worth angel investors versus syndicates. I mean, there's definitely funds out there that will do it, especially if you have a track record as a founder. Hopefully that answers your question. And Alec, I don't know if you have anything else to.
No, I agree. I definitely think it's more of like a friend's family who you might know, because they're really making a bet on you as the founder, and they'll either trust you or they won't trust you. I think it might be a very uphill battle to kind of try to get some money from someone that you don't know, especially without anything to show on actual execution. So I tend to agree on that front.
Thank you. The next question is, do pre-revenue brands have any chance in an investment? We need the capital to fulfill orders or interested buyers and approved pilot runs.
Pre-revenue consumer products is tough. I would say there's definitely funds out there that do it. Like I said, angel, being able to tap your friends and family network, angels that, people who know the category really well, that you can ask for a $50,000 check. It's very situational. I would say we tend to not do pre-revenue as an investor. That's really not what our mandate is. Again, we're an institutional investor. We raise LP capital to deploy that capital into consumer products companies. And as part of that, we have a mandate. We say our mandate is generally post-revenue companies. There are a handful of, again, we get a lot of deal flow from other funds out there that may be invested in a pre-revenue business, and we're getting that deal flow secondhand. So they do exist out there. If anyone after this call wants to email me and sort of ask me for any context around other investors, I'm happy to do it.
Great, thank you. Looking to fundraise pre-seed in beauty and find it challenging to find networking opportunities to meet investors in this space. How do you recommend we go about meeting investors in this space who are open to pre-seed stage?
Yeah, I'm sensing a similar theme between a lot of these questions. I would say, getting to know like all the thought leaders in your industry, like it sort of depends on your category, but really knowing who big players are in the space, either other operators. We see a lot of times when companies are raising a seed round with us, we'll see a founder who has bolstered maybe their cap table or their advisory committee with other people who are really good operators or founders in the space, other people who have started a business, can see talent, know how to spot talent, understand, the industry inside and out. Finding other sort of like-minded operators, that's one way to get started, or one way to sort of put together kind of a pre-seed round of funding to get you to that next institutional round of capital.
I definitely think, trying to find who these investors are on LinkedIn, try to see if there's any second connections that you could kind of get warm interest to. And if not, cold sales is also an approach. Not everyone's going to respond. Everyone prefers a warm intro. But, start to build these relationships early if you can, and try to crack in a network throughout. That's something definitely I had to do in the early days of Settle.
I think this question also is more of the same of that early stage pre-seed. What are your thoughts on inventory loans for early stage bootstrap startups? So,
yeah. Also, let me maybe just add one more thing. Just if you're a pre-seed consumer packaged good company, talk to your supplier or your co-man. A lot of times, they might have an equity investing program, or maybe it's not even a formal program, but, we've seen some companies who, when we go to make that seed round investment, we look on the cap table and we're like, oh, who is this? And it turns out, it was their contract manufacturer, it was their supplier who started them, got them on the right track with the business. They were their first supplier, and they helped them kind of do that first round of pre-seed financing. That says a lot to us too sometimes about if a company is able, if a supplier says like, we like this business, we want to fund it, and we want to get this, help get this business off the ground because we either believe in the product or we think there's a niche in the market that this product resonates to. We like seeing that. So that's just another avenue that you can think about as a pre-seed brand. And I'm sorry, the question was related to inventory loans.
Yes.
Specifically, if we recommend them.
Specifically, hold on, let me go back to the question.
I think the gist was kind of like, do we recommend inventory?
Yeah. So what are your thoughts on inventory loans for early stage bootstrap startups? So. Yeah.
I mean, here's what I would say is the earlier your business, the less a lender is probably going to value your inventory, meaning your ability to lend against your inventory at early stages, because that inventory is not necessarily, tested. A lender is not going to know if it's going to be able to use that collateral and sell it for, par. Maybe less valuable than in accounts receivable, right? So if you're able to sort of shop a purchase order around, a lot of times that might be a little more favorable. Maybe Alec, that's probably a little bit more in your domain. So if you've got something there, or anything you'd add to that.
Yeah, no, I tend to agree. It's if you're pre-rev, it's just going to be impossible to kind of get a loan. I think unless your cash balance is really high, so really that asset coverage piece. But if you're bootstrapped, which I'm taking as probably cash flow, then it just can be very difficult unless you have that sales history. Now, if you do have sales history, I think lenders like Settle or others could underwrite that. But another potential way would be actually working with your supplier. Try to get terms from them to kind of give you time to convert that inventory into cash. But on your last point, I definitely agree. Definitely, if you have like a PO from a retailer or buyer, it's a lot more useful in an underwriting scenario than without.
Thank you. Bill, you mentioned staying away from companies that have a significant amount of debt on the balance sheet. What do you consider to be a significant amount of debt?
That's fair. I mean, I would say generally for a seed stage company, we would probably stay away from situations where there were $3 million or more. Kind of, it's obviously contextual based on the size of the round. But at the end of the day, like a lender needs to get paid back if a company has significant amount of debt outstanding, and they're likely not going to be profitable. Again, when we're investing in companies, they're generally not profitable in those early innings. That's tends to be what turns us away. It might not be the outright dollar amount of debt. It's more about what is is this too large of a debt burden that this company is not going to be able to pay before that loan matures or whatever that debt security is.
Yeah, and I think kind of looking at that fifth metric, leverage, is a good way of kind of viewing that as well. If you just have a lot more debt than you might be able to repay, then is the equity dollars just going to come in and kind of pay that off, and then the equity dollars won't really use to grow the business. So that's something definitely I think from an equity investor's perspective they'd be looking at.
Okay, thank you. Couple more questions here. We've got a few more minutes. Should we know how much growth your capital will fuel at the seed round?
Yes. I mean, I would say you should know a couple things. One is, upon a successful raising of an equity financing round, what is your projection for how much runway that will provide you as a company? A lot of our companies will say we're raising $3 million seed round that will fund 18 months of cash runway for the company based on our model projections. And also understanding what type of top line, what type of revenue are you going to be able to accomplish based on that amount of capital. Having those two things, like you should know that like the back of your hand as you're raising capital and you're talking to institutional investors like us. It really gives us a sense that as a founder, you have a grasp on the business, you understand the numbers, and you know what it's going to take to get the company to where you want to be.
Yeah, I agree. And if investors are gonna really dig deep and rip apart the business, so you need to have answers to their questions and have a lot of confidence in them. If you kind of say like, "Oh, I don't know," then the investors might think you're not really taking this seriously. So I think you really need to understand what this money is going to get you, and what the future holds, so you could kind of sell that vision to them.
Okay, great. On the leverage equation, isn't equity always 100% in the aggregate?
No. So the parts of the balance sheet break up as assets, liabilities, and then equity. So assets will equal liabilities plus equity. So let's say you raise $1 million, you're gonna have $1 million in equity. As you and assuming you're not profitable, you're going to start decreasing that equity. And at some point, unless you either turn profitable or raise another round, or a new infusion of capital, that equity is actually going to turn negative, which really means that your liabilities are outweighing your assets.
Thank you. If you are selling in multiple channels, how do you figure out repeat order rate?
Yeah, I would say it's very difficult to do it outside of direct consumer. So direct consumer is really the only place probably that you're going to get reliable data on repeat customer rate. I'm sure there is probably software out there and companies out there that can help assist and sort of analyze your retail level data. But as an investor, I would say we generally apply those metrics and we look at those metrics dependent, in the context of a direct consumer company, not necessarily a retail focused company.
Thank you. What is the difference from what you are offering and venture firm? Is there a difference?
Well, if that question's for me, we are a venture firm, so no, there's no difference.
Okay. Okay. Considering we have a strong interest from stores and distributors, valuable connections to industry consultants, but have not yet made sales due to food production legalities, what would you recommend we emphasize in our business plan to best attract investment at this stage?
That's a hard question. I probably wouldn't be able to confidently answer that without really knowing the context of the company. So it sounds like to me that the brand or the company wants to be. There's retailers who want to sell the product, but they can't get the production right, or again, I don't really understand the context of this question. So maybe if the person wants to put a little follow-up to explain it a little bit better.
Yeah, I agree.
Okay.
Yes. At a high level, what are investors' expectations around timeline to profitability for CPG brands, given the high upfront capital investments needed for listing fees, free fills, etc.?
Yeah. So I would say a fast path to profitability for a company that we first get involved with, again, like generally in that series seed stage, is 2 years. That would be a really fast time to profitability. And I would say, we've had companies that we've been investors in that I would still say are relatively, have been successful investments from us that took 5 years or more to achieve profitability. I think it's very, context dependent on a lot of things, category you operate in. Certain categories have higher degree of upfront marketing costs that are required. But if you could, if from seed stage, if you can show a credible path to achieving profitability in 2 to 3 years, I think that gives you, sort of a leg up. I would say most investors in my stage are generally going to, be a little bit cynical about that fast of a path to profitability, but it's been done.
So,
Yeah,
oh,
I agree with that. Generally, from we really start working with companies early on, but I think it's pretty uncommon to get profitable that quickly, just given the team you need to build. A lot of things are unoptimized, so we kind of see that 3 to 5 year mark as like the window. And now you might choose not to become profitable because you want to do more growth activities, but at least you have the option to operate profitably.
just going back to that last question, it's a challah beef jerky company. So just that, the strong interest from stores, distributors, valuable connections.
Got it. And so the bottleneck seems to be, maybe it's like related to how expensive it is to manufacture the product to achieve those certain standards that the retailers are requiring.
I mean, it's sales due to food production legalities.
Here's my recommendation. I would say, please feel free to add me on LinkedIn, and I'm happy to have a follow-up conversation after, maybe just to understand a little bit more of the context around your business and some of the bottlenecks that you're facing right now. I think it's hard to maybe just do this in a kind of a one-way, Q&A format. So let's take it offline.
I think we have time for one more question. What would you include in your contribution margin metric as an early stage food/bev founder or startup? Would a portion of SG&A be included?
I would not include SG&A. If you're a food and beverage company selling mostly to retail, I would say trade spend. So start with gross revenue, subtract trade spend to get to, and returns to get to your net revenue. From net revenue, subtract your cost of goods sold, your costs for outbound, warehousing, everything it requires to get the product to the customer. Those are what make up your contribution margins. And that's how I would think about it. And to the extent you have any fulfillment costs in SG&A, I would include those in your calculation of contribution margin. If you don't, then you don't need to.
Okay.
I wanted to ask specifically to touch on the difference between VC and settle working capital.
Yeah, so on the settle side, we are not taking any equity into the business. No, so we don't have any ownership in the business. It's non-dilutive from that perspective. We're giving out transparent loans, not merchant cash advances. So you're getting a low APR and it's fixed. So there's no chance you're going to be paying 50%, 100% APRs like you might with MCAs. It's definitely shorter term, so we'll go anywhere from 60 days to 180 days. So that's kind of like the working capital window you're trying to solve. I could definitely opine on Bill's product, but I'll let him explain it.
Yeah, I mean, I would say with an equity partner, if you raise equity financing from a group like us, we are somebody who we are looking to be investors in your company for 10 years. I mean, generally for I think historically the average sort of path from seed investment to an exit for a seed stage CPG company is over 7 years, 7 to 8 years. So we're generally partners with you for the long haul. We're not getting payback on our investment. There's no sort of expectation that in a year you owe us, our principal plus interest back. That's not how we work. But the downside of working with a group like us is you are selling ultimately a percentage of your ownership in the company, and there's going to be there is a dilutive nature to a transaction with a venture capital firm like us that you have to consider. I think truthfully, the best businesses that I see in CPG, if they raise outside financing at all, is a hybrid of both equity and sort of strategic debt alongside of it. And I think having that well-rounded cap structure is pretty important.
Thank you. All right, I have 2 more questions. We want to go for it?
Yeah.
Okay. All right. What does equity share for the VC look like for early stage investment? And does capital require voting shares?
So I would say tend to think about a traditional dilution from a seed or Series A round somewhere around the ballpark of 20%. I think that's probably a good median amount. I think that answers the first question. The second question, not always. If we're participating originally in a company, if it's like let's just say it's a convertible note or a SAFE, our expectation is that that security is going to convert into preferred shares. So yes, there is sort of voting considerations along with that. We don't always, require a board seat upon our investment in the company. It sort of depends on how much we're investing and some other details around the company. But a lot of times we are asking for board seat as part of our investment, which obviously entails a whole, different structure around your corporate governance and things like that. So,
and I think a good way to think about it is, Bill and other VCs are raising money from LPs, which are just investors. And this is very illiquid investments, as Bill mentioned, 7-8 years for an exit. So not only does it have to be returns that could get from the stock market, but those stock market investments are very liquid and they could just exit the position right away. So they need to be even better. The ownership really equates to a return on the capital. And that's why it might seem expensive, but in reality, it's probably a very fair cost of capital.
Thank you. And one last question. Does Settle provide financing for POs from national retailers?
Yes.
Okay.
Easy question.
Awesome. Ending on an easy one. I love it. I want to thank you guys so much. Alec and Bill, this was an amazing presentation. We're getting a lot of really good comments that people are loving this presentation. I wanted to let everybody know that we'll be sending a copy of this presentation and the recording to everybody. And you'll be able to view this information. Please get in touch with Settle. Take advantage of that promo, and thank you everyone, and have a great Startup CPG 23, easy to remember. That'll be sent out too. So somebody's saying the best presentation on this topic to date. So you guys knocked it out of the park. Thank you so much.
If I could give Bill a lot of caffeine and just have him like tear down businesses for an hour, I would love to see that.
That'll be the next one we do.
That's the next webinar. Well, everyone have a great night. And again, Settle team, thank you so much.
Thanks, everyone.
So much.
Bye.